Yo, what's up guys? It's your boy Looney. Today, I want to show you how to build a portfolio that literally pays you every single week. And I'm not talking about dividends or waiting around for months at a time. I'm talking about selling options. This is one of the most consistent strategies I run. And I'll walk you through how I'm setting mine up right now with real trades on Archer, Mara, and Oscar. But before we get into it, quick shout out to the Discord. It's free to join, and I also have a premium membership for $8 a month where you get one-on-one coaching, trade callouts, my option selling course, giveaways, and more. The links to that are in the description. So why option selling works weekly? So the reason that selling options is so powerful is because unlike buying stocks or even buying options, you get paid up front when you sell these options. Every week when the option contract expire, you either keep that premium or you get assigned shares you already want to own. And then you just rinse and repeat. So that's why I call it building a weekly paycheck portfolio. You're not relying on companies to pay dividends once a quarter. You're writing your own paycheck by selling puts and calls week after week. So let's actually pull up Archer because this one is a cash secured put that I set up today. And I gave this trade to my Discord or my premium Discord. And these are the type of trades that I provide. And for those that don't know, cash secured put, that just means you're putting up enough cash to buy 100 shares of the stock at whatever strike price you chose. And if the stock drops below your strike price, you'll be forced to buy it. So for Archer, the premium was pretty decent for a lower ended stock or a lower price stock. So I don't mind owning shares at these prices, especially with that premium, because that's usually how I factor in my cost basis. And Robinhood itself sort of does that too sometimes, where if I buy these shares for $8, it's going to factor in the premium and it'll probably show my true cost basis as 7.76. And I think that's a perfect price to own Archer at. And I'd be totally comfortable owning it because if I get assigned, I own the shares cheaper than what the market is right now. And I could also sell covered calls against these shares, but we'll go over that in another video, or I have other videos discussing that. Either way, I'm getting paid that premium up front. So if the trade goes against me, I still get that premium. If it goes with what I want, where it expires worthless, I net gain that premium. So it's sort of a win-win. The only way you lose is if the stock drops really low. But if the stock drops really low and you were to just buy it and hold, you'd be in a similar situation. So selling puts is a great alternative to just buying and holding. And I was looking at a few things. I noticed that this stock did drop. Ideally, you wanted to sell puts on red days. And this one had a slight red day. It wasn't a significant drop, but it did drop. And this market sort of seems to be in a situation where every dip is sort of bought up. So although you have to keep in mind, this isn't like a big position in my portfolio. So I was very strategic. And if it does drop even further, perhaps I'll set up another cash secured put. So if you are thinking of doing this trade, make sure you're allocating cash appropriately and it's not taking up your entire portfolio when you do these sort of trades. But you can see here, it's trading above the 200-day moving average. The RSI was sort of low or signaling that it was oversold. And yeah, I sort of just set up a put at the time. Actually, I wouldn't say the RSI signaled a oversold, but the RSI was sort of in the middle. And yeah, I was just sort of in the idea that the market's been very bullish recently. So any kind of opportunity, I wanted to take advantage, and especially at this price. So if I look at the lower Bollinger Band, right now it has 8.86. So the likelihood of it going even lower than 8 is pretty unlikely or pretty low. And if it does, that sort of tells me that I bought it at a cheaper price. And yes, you can look at a bunch of indicators. You don't want to get analysis paralysis where you have so many different indicators that you can't even make up your mind. I look at a few, Bollinger Bands being one of them, RSI, MACD, they kind of work hand in hand with one another. And yeah, these are the ones that I think are just the easiest to use and they make the most sense to myself and my strategies. So selling puts, this is what I use. And that's why I set up this trade. And we'll see where this goes. I opened it today and it expires in a month, I believe. I like to do monthly options because it's less management. If you do weekly selling puts, you do have to do a little bit more management, and I don't want that. So I did a monthly trade, or just about a month, and that was one of them. Now let's look at a different strategy, and it's similar to selling puts, but it's actually a cheaper alternative to selling puts, and something that I've been wanting to do recently, because I don't think buying shares at today's prices for a lot of stocks is appropriate. So instead of selling cash secured puts where there's a chance of getting assignment, I'd rather be in a scenario where if I lose a trade, I just lose some money and I don't acquire shares, because if I do acquire shares and the market continues to go lower, I'll be in a tough situation. So I'd rather just have that situation where I cut my losses short. And what we're talking about is put credit spreads. And I did it on Mara and Oscar today. And like I said, that is why I was doing them. But let's actually pull one up. These ones are pretty volatile stocks. They're a little bit more expensive. And that's another good reason to do credit spreads if you can't afford to do a cash secured put, because cash secured puts does require a lot of capital. You could set up a credit spread. And basically what it is you sell a put at a strike price. Usually you want to sell out of the money. And I do like a 0.2 delta. I try to go a lot safer with these sort of trades because they are defined risk. And then you want to buy a put at a lower strike as a protection. And that sort of caps your gains, but also caps your risk. And similar situation where you collect premium. In this scenario, I collected $52 worth of premium because I set up two trades. And yeah, I set up two trades because I didn't think one was enough. So with Oscar, I have one at $15 and $13 puts. So if the stock goes below this, I'll have to manage it. Perhaps I'll have to close for a loss, perhaps not. We'll see. But the true break even is 14.74. And I'm just going to wait it out because with selling options, time is on your side. So simply just waiting things out is sometimes the best play when selling options. And if it does go below 13 or it goes below 14, that break even, then I'll consider, or I will have to close it for a loss. But again, I'm okay with that. I don't want to own shares at these prices. And especially like $15, I don't want to own Oscar at 15 because my average cost is $14. So I don't want to increase my position there. And if Oscar continues to drop lower to that $12, $11 range, I'd rather just buy the shares there or sell cash secured puts there and actually acquire shares at those prices. So this is a put credit spread on Oscar. You could see here. And then also Mara. Mara is one that I set up as well. This one, I set up 3 instead of 2. And for doing that, I got paid $45. I did a safe delta, or at the time it was safe. I'm curious to see what it is now. Let's see what this sell put was. It's a delta of 11. So it actually is doing pretty good. You can see it's already up 27%. And this one's the buy put. So this obviously is going to be down. And I'm already up. I'm already up $12. I opened it today and I'm already up 26%. I believe when the market opens tomorrow, it might show a little different with the returns, but that's the thing with options. They are pretty volatile, so they move a lot, but just being patient, especially selling options, like I said, is one of the best things to do, is to just kind of leave things be, let things play out, and let that income or that net profit work itself out. So yes, I got $45 in premium, but you don't realize that gain until the options expire or expire worthless. But with credit spreads, most of the time I will sell early, or not sell, I will close early to realize that gain, because sometimes you might have to be in a situation where you're in between those strike prices and there's a chance of assignment and being short stock. So it's a tough situation. Ideally, you want to be above that $14 put. But if it goes in between the two, that's probably the worst case scenario. If it drops lower than 13, it's still a bad scenario and you can just close for a loss. But that's sort of the game with selling put credit spreads. And yeah, these are awesome types of trades. They're cheap sort of trades. So if you don't have a lot of capital, this is a sort of trade you might want to be looking at for collecting that safe passive income. And again, these aren't flawless, so there's a chance that this goes wrong, and that's why you want to make sure you're allocating cash appropriately. In this scenario, I had to put up $300, and the way I calculate that is because it's the difference between the strike prices times 100. And again, I had 3 of these. So it was $300, and that's the amount of cash collateral I had to put up. So if I look up Mara and look at the cash, the collateral, it says $1,650, and it's because of that. Let's actually look at Oscar. Oscar might show a little bit more sense. I do have a cash secured put on on Mara, so that's why it's a little bit higher. But yeah, you can see here $400 of collateral, and that's because I have 2 contracts at those prices. And the key here is to be consistent, to focus on consistency. Don't rush into trades. Today was a red day. I just took advantage of that. We're kind of seeing that the dip's being bought up. Sure, the market can continue to go lower. And if it does, I might even do more trades. And that's how you dollar cost average. And you can even apply that with just buying shares, dollar cost averaging. But you can see I'm not swinging for home runs. I'm trying to stack these small wins week after week. And when some trades expire worthless, while others get assigned, some do need management, like maybe rolling positions, which is another technique that's a little bit more advanced, rolling options. I have other videos on it as well, but we're not going to go over that in here. But overall, the premium keeps flowing in no matter what. And what I like to do is diversify the strategy inside my portfolio. And I do cash secured puts for stocks I really want to own at prices I like. And then I put in put credit spreads for higher risk names and with limited collateral. And once I own these shares with the cash secured puts, because put credit spreads, you don't acquire shares. You just either realize a gain or a loss. But cash secured puts are the ones where you do get to own shares if assigned. And once that happens, you could flip to cover calls, which is a very similar strategy, and you collect even more weekly income with doing that. And that's how you build a portfolio that pays you like a paycheck. And you can see here, past year, I'm up 50% and overall up around 60%. So it is a consistent strategy. And that's why I've got my Archer put working, the put credit spreads on Mara and Oscar, and I'll continue stacking premium. It's not a flashy strategy, but it is consistent. And that's how you grow an account. If you got value from this, drop a like, sub if you're new, and let me know in the comments if you're already selling options or just starting to learn. Until next time, peace.